Traders, welcome to Charts and Coffee. Happy Friday, everybody. Hope everyone's doing great. All right, so just a quick thing before we start getting to the questions, feel free to type them in. I'm going to take everyone over to the economic calendar because some of you might have noticed already pre-market, we had a pretty significant amount of volatility. That is our core PPI number. Core PPI would be under sort of the macroeconomic pillars that we look at: jobs, inflation, and growth. This would kind of fall under that inflation category. If you're ever at a loss for what the heck this alphabet soup of hot zones that come out are, over at forexfactory.com, don't worry about the Forex thing. It's just really a great economic calendar that shows global economic releases. You'll notice it's the change in the price of finished goods and services sold by producers, excluding food and energy. Anytime you have a core, it's excluding things because the logic is food and energy have a lot of volatility and they want to remove those to show a more steady number. And of course, the non-core, in this case, the straight up PPI, has food and energy. Why remove food and energy? I mean, heck, who needs food and energy, right? It just goes to show how sometimes ridiculous these numbers are. But nonetheless, this is what we end up looking at to understand the state of the economy. More importantly, this is what we look at to understand what challenges in this case are going to be presented to the Federal Reserve and why they might have to be more or less hawkish. That is exactly where this data maps to. So if I take a look at core PPI coming in just 1/10 hotter on the core version, again, remember removing those things we don't need like food and energy, and then the PPI, which includes those two things, both came in hotter, higher than expected. Core came in 2/10 higher. Uh, Regular old PPI came in 1/10 higher. What does that mean? Well, you'll notice that at 8:30, I'm going to show you what the chart looks like in a moment. I'm also going to show you all our measuring tool for the Federal Reserve. And that is an understanding of where we sit in terms of expectations for March of next year and for May of next year, and what our expectations are for rates. It does seem that the 5% to 5.25% column is starting to move up, which is, if I think about the zone of where the terminal rate is going to be, what's that peak rate? We've been kind of going between two choices: 4.75% to 5%, and 5% to 5.25%. Neither are surprises. It's just really one is obviously less hawkish than the other. The 4.75% to 5% column is going to be generally bullish for equities, while the 5 to 5.25% is going to be a little bit more bearish. Let me show you all where we are on that move. Now, remember, gang, market's moving lower, right? We always want to take it within consideration of the typical historical volatility, not the candles that come before it, right? Because the candles that come before it are in wait and see mode. They're actually compressing as traders or investors don't want to front run necessarily this release. Was this a more volatile than normal candle? Yes, you can see our hourly price movement ranges started to stack, started to overlap. So those of you that are using HPMRs, or those of you that are considering using HPMRs, one of the wonderful things that they do is they give us a visual warning of, hey, this is beyond what is the 68% probability of price movement. But then another question is, well, did this move beyond, say, today's price movement? Not even a little bit. So if you're wondering, how do the daily volatility levels compare to the hourly definitely got upended, right? We exceeded that historical norm, but the daily, not even a little bit, right? We are still actually quite narrow on the session for today, Friday. All right. And why the move lower? Why this move at 8:30 lower? Because any data that suggests that inflation is ticking up is going to force the Federal Reserve's hand to be more hawkish and favor that 5 to 5.25% column. And that would probably move not only the terminal rate to that 5 and a 5.25%, but to possibly May as a time of year that we peak on that target rate. All right. So with all that in mind, Let's go ahead and dive into the questions. And I see quite a few of them coming in. All right, so let's see what we have coming up. And by the way, gang, I do want to mention this because it's Friday. And for those of you that are not accustomed, I know we have a lot of traders that are just sort of venturing into futures and learning how to trade futures, which makes me unbelievably happy because that is the market that I cut my teeth on. That's the market that I just absolutely love. And even if you're a stock trader, when you understand what's happening at the top level, the indices, you're going to have a huge advantage over traders that don't understand a stock's weighting within indices and sectors. So I love, love, love that so many traders are getting into futures, but there are a couple things to learn. These pesky contract months, which seemingly make no sense as to why January is the F contract and February is the G contract and March is H, but you'll just memorize them. There's only 12. We are looking at, if you take a look, as we go into the roll, remember, this is the way the different contracts roll. What does that mean? We see the open interest migrate from the current front month to the next month. We see the volume migrate from the current month to the next month. So one contract is winding down, it's getting ready to expire, and the other contract is going to pick up in pace. Okay. So you can find this over at the CME, and you'll see it's equity index roll dates. In fact, if you just Google CME roll dates, it'll bring you this link. All right. So we are in the midst of that roll. If you're ever in any doubt, look at the open interest. Look at what the open interest for the current front month, which is Z, and then start to look at the next front month, which is H. When you start to see the open interest start to move and get higher than December, than Z, then you know that's where all the interest, that's where all the action is going. All right, let's kick it off with the first question here, which is, I'm confused. Let's see, ES movement. Oh, the wave. Just round up or round down. So the question is, I'm confused that S&P moves in increments of a quarter. Yet when I look at Thinkorswim at the 34 EMA wave tool, it's not always moving in those quarters. Remember, the 34 EMA wave is actually a 34 period exponential moving average. And so, yes, just move up or down. So if you see 39.6825, just move it to the quarter. If you see 39.7435, just move it down to the quarter. So just round up or round down. That's all you need to do. Really, really easy. All right, next up is, what are my thoughts on supply and demand zones? I've been uncertain about whether to enter a trade within the wave. So I'm trying to find confluence of demand zones within a wave on a pullback. So, Jochen, I would say, look, I don't know if, when you say supply and demand zones, I actually don't use those. I'm not even 100% certain what that is, to be quite frank. But what I would say is, my way of looking at supply and demand is by looking at volume, 100%. What is the VWAP? What is the V score? What are V profile levels? In other words, point of control. That's the most volume that's occurred at a single price based upon a certain segment of time. Value area high, value area low. So if I'm looking at the wave, let's always remember, structure dictates strategy, even in the way that I'll use volume. So I'll start with the strategy of, are we in a trend or not? An easy way to look at, say, for example, a trend, and one that we're all really familiar with, is the Dow. And the Dow's moving higher. So the next question is, do I have a support or resistance zone, or what'd you say, supply and demand zone? So I'm going to ask myself, where are my where's my V score support at? Where is the volume weighted average price? Because to me, supply and demand, or support and resistance, or whatever we want to call it, right, without volume is an incomplete picture. So take a look at the white line here. That's the VWAP. To me, absolutely, without dispute, the 32,870 level is going to be a thick volume level. If price is above that level, that's a support level to me. So that's the way that I look at that. Now, if I want to then overlay what I want to do with the wave, you're right. I would probably want to focus on the lower half of the wave if I'm looking to stack size and price, right? Or volume and price. Remember, there's always four factors. I love that you're looking at more than just price. Most traders of the four factors we can look at. They look at price and then that's it. So we look at price, we look at volume, volatility, and time. So if you can stack volume and price to your point, you're definitely going to be head and shoulders above most traders working one dimensionally in simply the price world. So awesome question there, you and that's the way I would look at that. Okay. All right. So next up is I was wondering, good morning. I was wondering what kind of computer setup do I need to trade my strategy? Oh gosh, it's I know I talk a lot about, being here in my office and I sit in front of this, right? But remember, gang, I do this absolutely positively full time. I lead, say the sector secrets mastery room or the futures room in trades when I'm in the room. So I want to be as well equipped visually. I want all that real estate. In fact, I would like to add a couple more monitors. The more I can see, the more I can convey to the traders in the room, right? So I feel that's my responsibility. But is that what you all have to do? Oh gosh, no. I'm getting ready to travel to Austin. As many of you know, we have our Austin mentorship coming up. And if you haven't already signed up, I'm looking forward to seeing you all there. I'm going to be presenting with the Lorna bot. I'm super excited about that. I think I've got a session with, I do have a session with Bruce. I've got a session with John. So I'm looking forward to seeing everybody. And even if you can't make it, by the way, we do have the virtual live stream available now. But I'm getting ready to pack and travel to Austin, which means I've got trades to manage on Monday and Tuesday when I'm going to be away from the bat cave, right? Away from my room. And remember that when we travel, look, I can't take this awesomeness with me, although I would love to. What I travel with is a laptop. It's a Dell laptop. And I flank that Dell laptop with two, I think they're from AOC, I believe. And they're two roughly $120 portable monitors that plug in with USB. So at least I've got three screens. The reason I like that is I can have at least one or two screens for my charts, usually one for charts, one for order entry, and then one for the chat room. So if you've got a laptop, and if you're not day trading, even though you probably could day trade, if you're trading a 1 hour chart, 30-minute chart, daily time frame, a laptop is more than enough. If you're trading a little shorter term, invest in that extra monitor that can flank the main screen. You're going to be amazed how much more productive you can be. And then if you can go 3 or 4, and I've done the 4 thing and they travel really well, then you've got even a better view. So the most I've traveled with is 4 monitors. And normally the least I will travel with are the main laptop and one extra monitor, but I like to flank it. Plus, I just like the way it looks. Okay. So to me, ideal for most folks without, the ridiculousness. I get it. It's pretty ridiculous. Without this is a dining room table, just to give you the scope of size there. It's an IKEA 82 or 90-inch dining room table. Uh, is the two portable monitors and a laptop. You can even do that. So I think that's very, very functional. All right. Thanks for the question. And that's what I'm going to be traveling with. My computer stuff takes up more room than my clothes. Luckily, I'm pretty much a uniform dresser, as we all are, right? My computer stuff is 3/4 of my suitcase, and my clothes are the rest. All right. AVGO for a long. Let's take a look. We want relative outperformers, gang. We are seeing strength in a handful of broader averages, and AVGO, absolutely, Joe, is one of those relative outperformers. You can see that we've gone green. We'd like to get above the anchored VWAP. We are, however, take a look at this. We are, however, above the 200. Gang, that is a huge level to have been able to climb above. If we think about the most basic of sort of scanning software that so many traders do use, scanning software looks for technical commonalities amongst disparate stocks. Now, uh, that means that the common factor, these stocks within a scan, the results will be they've met, 1, 2, 3, 4, 20 criteria, whatever your criteria is. But one of the most basic criteria is whether or not a stock or an ETF or whatever, futures contract, is above or below the 200 exponential. For me, sometimes 200 simple. I like the exponential version of moving averages. There's all sorts of different moving averages. I just happen to use the exponential, and being above that's quite bullish. Joe, buy the dip. Buy the dip is what's in play. Yeah. And even at the 200, you could do that. Is the HPMR indicator free? I do make a free version and have for many, many years. When I say a free version, it's a limited pack. I make it available in the futures room and in my sector secrets mastery. It is the S&P, Nasdaq, Dow, and Russell in the futures room, and then the S&P Dow, Nasdaq futures, and ETF alternative in my sector secrets mastery room. And so I do make those packs available free to those members. And then we have a premium pack, which has over 70 symbols right now that have the hourly price movement ranges on a number of symbols. Where is my HPMR? Right now, and that is a subscription because we do update those, and that is what this is. This is an indicator that I created about a decade ago at this point. We've been automating it and fine tuning it. And right now, this is by far my favorite version of this algorithm, which is, it is an algorithm, it's math that I've ever used. And I'm really pleased about the array of symbols we can support with it now without, this is the important part, bogging down Thinkorswim or TradingView, which is available on both. All right, next up is good morning, Harry 403. After viewing my video yesterday, I have installed your indicators on my chart. Awesome, thank you. I have assessed that HUN, all right, let's take a look at HUN, is by the dippable. I love it. Would I concur? Okay, so what we want to do, and the layout that I believe 403 is referring to is the free layout that I've made available in the rooms, as well as the pieces of that layout are available for free on TradingView. And that is the 34 EMA wave, grab, propulsion, and the automated support and resistance of the Darvis. And that's called the TOPS system layout. The pullback by, yeah, I like that 210 area. It is by the dippable. And the reason it's by the dippable is because we've had an uptrend in this thing since November 1, November 2. Yeah, you're spot on. Good eye. That's how, and I'm curious, 403, how easy was that really? How easy was it to say green trend, I've got a consistent green wave above the propulsion. I can see the wave there. It really does decode the market's structure, the market's psychology really, really well. And it's not that top system is just for tops. Let's say you've got an oscillating indicator and you want to know how to more tactically accurately use it. Let's say you've got a breakdown indicator, like say squeeze, and you want to know how to more tactically use it. Let's say you want to look at whether or not to buy a 50% or 618% Fibonacci retracement, expecting a continuation. How would you know to use it? Tops will basically be the first step in your trading, but it doesn't have to supplant anything else. It's like having a really experienced caddy tell you, after looking at the lie of your ball, this is the club you need, and this is sort of the way you need to swing it, right? Tops is really like that experienced caddy, right? And that's the way I look at it. It doesn't have to, it's not going to tell you to change your clubs or anything like that. It's going to tell you which club should you use. And I think that's super important. All right, Raphael, good morning. Can I help me understand the proper structure of market sector, industry, and stocks? Can I help you understand the proper structure? Example, when I'm looking at the S&P. I'm not quite sure what you mean, the proper structure of the market sector, industry. You mean what's inside the S&P, I guess is where you're going. So if I want to look at the S&P, let me go to my multi-charts here. So this is a layout that we use very commonly in the Sector Secrets Mastery. Well, what this is the sector or the index in the upper left-hand corner, and then the individual stocks weighted according to their heaviest to lowest weight in the top 11. So this is the way I would look at the stocks within the S&P or the ES futures. And then the other way you could look at this would be to look at the index and then to look at the XLK, tech, XLF, financials, and XLV, healthcare. And those are the three heaviest weighted sectors within the S&P. So whether you want to look at the weighting of the individual stocks, that's what's on the screen here, or whether you want the sectors, I just listed those, K, F, and V. That's the way that I would break that down. All right. Yeah. At the end of the day, gang, we can call things whatever we want. supply, demand. It's all just support and resistance. So the thing that experienced traders know to do is to understand, how am I determining what the support and resistance is? We can use time, we can use price, we can use volume, we can use volatility. So I think it's really important to remember that really everything is support and resistance. And support are the bidders and resistance are the sellers. And then if we can look at size and volatility and basically overlay that, now we know what we're really dealing with. So I don't differentiate, whatever that is, supply and demand levels from support and resistance. To your point, GT, that's exactly what they are. But what's really important is we know how those levels are being derived. All right, gang, time's up for me. As always, thank you for the questions. Thank you for your time. Thank you for being a part of the Caffeinate and Dominate crew. I will see you all I'm going to try to do the Raghee report on Sunday, even though I'm going to be in Austin. I'm not 100% sure, but I am going to try. And I'm going to try to also do our charts and coffee on Monday and Tuesday while I'm in Austin too. Okay, gang, be good to each other. I'll talk with you soon.